Well, welcome everyone. Really pleased you can join us today. My name is Marc-Andre Pigeon. I'm the director for the Canadian Centre for the Study of Cooperatives, University of Saskatchewan. And I'm joined by Mamun Abudllah, a colleague of mine in the Edwards Business School, also at the University of Saskatchewan. And it's my great pleasure today to speak with Eric Dillon, who's from Conexus Credit Union. Eric's going to introduce himself a little more formally, and so I'll pass the ball over to you, Eric.
Thank you, Marc-Andre and Mamun. Great to chat with you again. My name is Eric. I'm the kind of CEO and head coach at Conexus, lifelong credit unioner, 25 years in cooperative finance. But all of that said, never operated a cooperative in an environment quite like this.
So Eric, this is of course the subject of our conversation today, and you've had long experience in the cooperative sector. How has that cooperative structure or identity helped you or not in this crisis? How would you characterize the way it's adapting to this event?
Well, I think maybe the biggest advantage to being a cooperative in something like this is just the patience of our shareholders. The alignment of the interests of our member owners, the financial consumer, and the interest of the cooperative are totally aligned, and it's about the sustainability of both, not one at the expense of the other. And I think it becomes a real advantage when you're dealing with members that have stress and anxiety, and there's been massive disruptions to their revenue if they're a business, or to their family if they're a consumer. So I think that alignment makes it really easy then to make decisions and do things that are in their interests, which ultimately are in our interests.
Great. So that opens up the next question, Eric, which is what are you doing exactly? How can you tell us a little bit about some of the things you're doing with your members that people might not be aware of?
Yeah, I think it's hard to put on a billboard, but really easy to speak to. So I think the big difference for us versus the large publicly traded banks is, they'll develop programs and try to then take programs and apply them to homogenous groups of people, just because of the sheer number of clients that they have. I think the beauty of a cooperative is our size allows us to not have to try to fit a round peg in a square hole. So our approach around really focusing on the financial health and the financial well-being of our member owners allows us to do this like hand-to-hand combat, advisor to family or advisor to business. So each of the resolutions that we've taken with member owners have been 100% segmented to an individual. So whether it's disruptions in a single business cash flow, and I was exchanging emails with one of our business owners in Saskatchewan just last night about a microbrewery and what's happened to his business, but he's been able to pivot some of it to other kinds of things. So his circumstance is different than the microbrewer in Regina that we do business with. So we've just really taken this really individualized and custom approach to helping our member owners. And again, I think it's a part of the advantage of being small and perhaps more nimble and better connected to the member owner than perhaps our bank competitors are.
I'll pass it over to Mamun if he has a follow-up question.
Yeah, Eric, so I guess you have already touched a part of what I was going to ask you about the advantage or disadvantage of this credit cooperative model in general. But I guess I'm going to ask you a bit of a different question. So do you see in broad scale, an opportunity for credit unions collectively in these circumstances?
Well, absolutely. And, I was, in fact, just this morning, we have quite sophisticated analytics capabilities at Conexus today. And I would tell you two things happened this morning that were almost, I'm asking our team to go back and actually prove them out because I didn't believe the analytics. One was that our net promoter score has gone up. Highly unusual for a time like this. Mm-hmm. And the second thing was, of course, we're very unique in that we've developed our own proprietary financial health index. Mm-hmm. The financial health index of our members went up.
Okay.
which again, highly unusual result at a time like this.
Mm-hmm.
But I do think it really speaks to how we've been able to tailor solutions to members that clearly they have high satisfaction with, because our satisfaction rates now are greater than they were in January.
Okay.
Remarkable. So I'll let Mamun follow up with another question if he has one.
Okay. So do you think that the federal policymakers have done enough to make their programs available to especially the provincial credit unions? And are there unexplored opportunities for the federal government to work with the provincial credit unions, in your thoughts?
I'm glad you asked. I was actually going to come back to the disadvantage question, because that's it, and you hit the nail on the head. Although we launched what's called the CBOS program concurrent with the banks, and I believe we might have been the only credit in Canada to launch the same day they did, I would tell you it was a significant government relations advocacy effort over the course of a 2-week period to get the same permissions. And yet that program in particular, and for the listeners and viewers, it's $40,000 interest-free loan, 10,000 of which will be forgiven if certain conditions are met. The target market for that emergency financing actually fits right into the credit union business segment, in that we deal with a disproportionately larger number of the micro and small businesses. And frankly, if you add up the credit union's market share in the small business sector, we rival the Royal Bank today in terms of number of clients. And at first blush, credit unions were going to be by and large excluded from the distribution of the government supports. So I would say 2 things were going to happen. There was going to then emerge tremendous regional disparity, because particularly in Western Canada, more small businesses are financed by credit unions and banks. It's different down east. So Western Canada would have been, I would say, disadvantaged considerably. And then micro businesses, again, that are served primarily by credit unions, wouldn't have had access to that money, which clearly wasn't the policy intent. And I'm not trying to be overly critical of government. They were trying, with the best intentions, to find ways to quickly flow money from the federal treasury into the hands of people that needed it. And so I don't begrudge their effort or intent, but certainly it was a large oversight from my perspective. And there's still credit unions to this day that aren't offering those programs because of some of the bureaucracy of getting approved.
This is an issue. I've had similar conversations where I've heard similar things, and what's striking to me, a couple things. As you, Eric, I don't presume ill will. I presume goodwill on the part of these folks. But inadvertently, what happens too is, and a third consequence is that you tilt the playing field too in favor of banks.
Clearly.
Yeah,
and particularly because those government programs were one of the conditions precedent was you had to apply where you had your main operating account pre-crisis.
Exactly.
So, I would tell you that thankfully, I think the government found a way to quickly onboard at least the largest financial cooperatives to solve part of the distribution gap. But I know some of my colleagues are still fighting that battle yet today.
The other thing that strikes me about this is that going back to your earlier comment, you have this kind of incredibly rich understanding, I guess, of your members and those contacts you were talking about, those very personalized contacts. That adds to a level of understanding that, data can tell you a lot, don't get me wrong, but that kind of one-on-one contact adds to that, I would imagine. Is that fair to say? Is that kind of soft information?
It is, and I would actually go further, Marc-Andre, to suggest that, if you think about a global financial crisis that occurred a decade ago, lots of credit unions didn't change any of the underwriting policies. So we have a tighter relationship with those businesses and the member owners during a very challenging time, whether it's World War or global financial crisis, but also credit unions are less likely to then go and change policies and introduce more risk protocols at a stressed macro environment time, which is counterintuitive to what actually needs to happen to recover in terms of an economy or a society. And I think credit unions actually have done a better job of not having a knee-jerk risk response to a challenging macroeconomic environment, which lends itself to being better placed to help the government distribute that kind of funding.
Marc-Andre, can I jump in?
Please do, yes.
So I think you have raised a very, very interesting and important point, which is a long time ago when I was still a graduate student, we used to talk about relationship banking. Okay, as the banks have gotten bigger, that relationship banking has evaporated quite a bit. Okay, I think the credit unions are well positioned, given their size and given their amount of contact with the local population and the local businesses. Do you see that? I guess what you were describing was that being the advantage, rather than just looking at the risk matrices as to where you should hike the rate and whom you should block from getting the loan. Is that kind of what you are pivoting to?
That was, well, again, I think there's 2 points. That's what I was trying to point out earlier for sure, is that I think we've taken an approach based on the relationship of trust and advocacy and satisfaction that we have with our member owners that allows us to better able manage through individual economic circumstance. But the other thing that's happening, Mamun, in the industry, think about things like open banking and payments modernization and all those things. Then the next holy grail, I would argue, for cooperative finance, but perhaps for the industry more generally speaking, is around giving people really authentic and expert advice about how money can start working for them and fund the hopes, goals, and dreams that they might have as families. And open banking is going to make that a much more transparent activity in the years ahead. And yet we've still got financial institutions, primarily, again, publicly traded banks, that are rewarding and incenting advisors based on the sale of products, which frankly speaking, in some cases does not contribute to enhanced financial well-being of the consumer. And in certain jurisdictions like Australia, the Royal Commission has now moved to disconnect variable compensation in financial institutions from the sale of products. I spoke earlier about the work our credit union has done around financial well-being, and our advisors are now, their incentive compensation is actually tied to the financial well-being of the group of households that they manage. So then at a stress or crisis situation like we're faced with today, you can appreciate while our advisors are very motivated to find the right answer for the client that actually helps them build resilience at a time like this, which again, I would hypothesize is the reason that our financial wellness scores have gone up in the near term.
I want to ask about that, Eric, because the first you had two kind of surprising findings you mentioned. One was the members' net promoter scores were going up, were positive, and this financial well-being. On the financial well-being, so what's going on there? I mean, are people saving more, or is it because the advisors are saying to them, be careful, don't maybe buy that new truck today, or what is going on that would drive that up?
It's raw data that I've seen this morning, and I haven't seen the detailed data. So I'd love to be able to, ping you back tomorrow or the next day after our analytics team has been through it. But my hypothesis is that, keep in mind that between 15 and 20% of members, and our data would be consistent with the banks that I've seen in the last few days, have deferred near-term credit obligations or reduced interest rates or gone to interest only or something to protect cash flow. And of course, then there's uncertainty both in the economy in terms of markets. And so I think people are just hoarding a little bit. So they've deferred near-term obligations and they've protected cash balances. That's my hypothesis, not yet proven by our own data yet.
And as someone who works in a university environment, I appreciate your respect for the evidence. So thank you for that. But I am curious if and I think there's some reason to believe people would hoard in previous episodes of difficulty. That's a kind of typical human response in the face of these, or kind of holding, being a little less free with your spending. Do you see any? And this is pure speculation, so I understand I'm asking you to go out on a limb. But do you see any change in people's behavior in any kind of medium to longer term sense, or is this, you think, it's just kind of temporary?
So on one hand, you applaud me for being evidence-based, and then you quickly then ask me to speculate.
I do. I take it.
Yeah, well, I think people are certainly, I would say, cautious. And that's on the business front as well as the consumer front. So our, demand for things like mortgages where people are perhaps growing families and moving into bigger primary residence, that's certainly slowed. Expansion plans for business has certainly slowed, while people are just, I would say, watching from the sidelines to see, I think there's at least line of sight now to when the health crisis might end. And then I think perhaps the bigger challenge and the bigger curiosity that people will have is around what will be the long-term impacts from the economic crisis, which is I think far more unknown, even for those of us in the finance industry.
Sorry, Mamun, do you have a question you want to follow up with? I have one or two more quick ones.
No, I think you go ahead with those.
Okay. So Eric, you talked about, and I'm jumping a little bit all over, but you talked about the engagement effort with federal department officials. What do you think was decisive in getting them to kind of come around in terms of this issue and making sure that credit unions were more, integrated into the delivery of that program?
Well, again, keep in mind that, the federal crown agencies involved in finance, Bank of Canada, OSFI, EDC, BDC, FCC, none of those really are reflective of the penetration and the real relevance of financial cooperatives in certain parts of the country, certainly like Saskatchewan, where I live. And so they just absolutely had no appreciation for the breadth and the capacity of some of the, size and sophistication of financial cooperatives, particularly as it relates to the small business market. I would just say, again, best intent, it just was not well understood. And once we, got in front of policymakers and when they were asking us about potential volumes for CBOS, I think when we gave them, the fact that we, have 20,000 or so business and agricultural members, that became a relevant conversation with them. They just didn't realize the scope and breadth of the market we serve here.
Very good. Eric, I think we're coming to the end of our questions. Is there anything you would like to add to this conversation that you think we probably should have asked about or covered that we didn't?
Well, I think the other the other thing that's, I think, going to be an outcome of this in some way, shape, or form is that, there's been this mass consolidation of financial cooperatives in the country probably for the last 10 or 15 years. And I think, it's typically around events, whether that's departure of leaders or a macroeconomic event or a technology investment that's hard to do on a smaller scale. And, I thought you might ask me about what the longer term impacts for financial cooperatives might look like as the economic conditions become more clear. I don't know the answer to it, but I thought you might ask.
It is a good question, and it is one I've asked in other interviews, and it just didn't come to me today. I think one of the things that immediately came to mind when I first started thinking about this was the consolidation question, credit union sector. Also the collaboration question, how well the system is working together in this event. We know there's been some tensions over the years, and then the federal option question. Those are the three things that kind of immediately came to mind. I'm wondering if you have any things, and again, I know this is speculation, so I appreciate it if it's not a comfortable space for you.
No, and I think, again, I've worked in all sizes and kinds of cooperatives in my 25 years. I happen to work for a large, both urban and rural cooperative today. And I would say, the question of federalization, I think, is an interesting one because the legislative powers have been created for a number of years, and there's very few takers on that today. I think, though, if you look at the 50,000-foot macro environment for retail banking, I think there's these fintechs emerging, like whether it's an 86-400 in Australia or a Revolut, or these are the the unicorn fintech companies, and borders are falling in terms of how they're serving consumers. And yet in Canada, we still seem to be a bit preoccupied with this idea of the regulatory borders that exist. As a systemically important institution in Saskatchewan, I would tell you we are very much an OSFI-like regulatory model in terms of capital requirements, liquidity requirements, monitoring, regulatory oversight. And so jurisdictionally, it's not much different in terms of the standards that we're held to. And I would also say, so that, you know, if the borders are virtually invisible from the regulatory front, and from a member's perspective, they really don't matter anymore because people are much more mobile and are just wanting to interact with their money no matter where they are, I think we should spend less time worrying about the borders and go to some kind of a passport system, recognizing that we're all, you know, highly regulated, reasonably sophisticated deposit-taking institutions operating on the same environment, and then let us respond best to how to serve members, which again has less respect for the dotted lines on maps than it once had. So I wonder if 5 years from now it will even be an issue.
Well, that's an interesting perspective, and maybe a subject for another conversation. I think, unless Mamun has any last questions, I think I'm done. Mamun, do you have a last question?
Well, going back to this fintech idea, one of the reservations I have compared to the banking model, and more so with the credit union or cooperative model, is that the fintechs are mainly data driven. Okay. Mm-hmm. And the qualitative component, is sort of missing. So I'm thinking about, for example, Rocket Mortgage in the United States, mm-hmm. Okay, where it's mainly data driven. Okay, credit unions, on the other hand, has this personalized relationship, something that you touched at the very beginning of this discussion. So I'm sort of thinking whether this would really be a scenario where we may see a lot of these fintechs, which are mainly data-driven, may sort of perish from this scene. What's your thought on that?
It's a great question. So I have lots of thoughts. One would be, I think credit unions have dramatically raised their own capacity around analytics. Mm-hmm. So I would tell you today we're doing some very sophisticated machine learning and AI applications inside our credit union around efficiency, around risk management, and around opportunities. Mm-hmm. And I would say, so we're closing the gap on the analytics capacity that existed elsewhere versus internally within our own credit union. Mm-hmm. Second point I would offer is that the fintechs really were up against an issue of trust with the data. And so I would argue the reason they've all moved to partnering with FIs versus thinking at one point they were going to conquer FIs is because they came to the realization that they don't have consumers' trust about housing the data and for what purposes and uses would be an outcome of that data. And then thirdly, I think they realized that the cost of distribution in financial services isn't going to go away. You know, they thought they were going to go to this completely light distribution model and people would go en masse. And I think some early adopters are going, but the cost, not just to build the distribution, but to acquire the customers in financial services is still a very real number and insurmountable for some fintechs, which is why I think now the fintechs are leaning more towards partnerships. The advantage for credit unions today is that to get a decision from a charter bank with 80,000 employees and 35 layers of management is very difficult. We went live on a fintech even 4 or 5 years ago in 39 days at Conexus. We don't have a partnership with them anymore, but there was a speed with which we could get to market, which is really important for a company that's trying to scale. So those credit unions that are of reasonable size, have the capacity to invest, have a bit of courage and risk appetite to consider alternatives, I think there is a really ripe partnership for fintechs there where they have enough distribution and scale, and they're still small enough to get in a room and make a decision quickly and allow the fintech to use some of the maybe perhaps great member functionality that's been created, where the credit union still owns the data, still can give those assurances to members, but can bring that new functionality to its member owners. And I think there's a really interesting marriage that is happening in real time, and we're doing lots of exploration and partnerships right now in real time.
Fantastic. Eric, thank you so much for your time today. Really appreciate it.